All right, so I put this post in the Patreon, just a post of the earnings per share on a trailing 12-month basis, and wanted to talk through a little bit how I'm modeling this out, and make it clear too. It's not like I post or show this graph or I put it on Twitter and be not like I'm making a declaration that this is exactly what's going to happen. But hopefully in this video I can go a little bit further and sort of show, depending on how we adjust the model, here's kind of the range of probable outcomes we can expect. And I think that's a lot more valuable for us to try and sort of understand the inputs and the variables behind that are moving that, as opposed to just, hey, this is a single static sort of prediction in time, but understand sort of a probability of curve of how this might come out. So jumping over to the model here, I just have that on earnings per share trailing 12-month TTM. And you can see, we're here and it's been curving up. And we're at, 2025 here. And we expect it's going to trend up, and somewhere this would be GAAP profitability. So somewhere in 2026, they'll hit adjusted EBITDA, but then 2027, they'll hit profitability. And then we expect a trend like this where there's going to become massively profitable, as Daniel said at Investor Day. So jumping over to the model tab, I will walk through how this is all working. So let me find where I am here, back to 2025, 2024 here. So how I had done this in the past, and I sort of explained this in another Patreon video I did, a week or two ago, was before I was really customer based, where I was looking at how much are we charging in, what's the customer acquisition cost per customer, looking at this cost to bring in each customer, and then estimating how much premium per customer each customer was bringing in, and then how much cross-sell, upsell there was on the entire book of business, and then trying to sort of, from all that, predict your premium, your customer count. You can also see within that your customer churn, a bunch of things. It all sort of derived from what the customers are coming in the door, how much premium are they bringing, and what are you paying to get those customers? Now, I've kind of, because Investor Day, they gave us this graph. I'll zoom in a little bit more here. It says how we plan to reach 10 billion, and they gave this rough breakdown. Of course, they don't know exactly. This is years out into the future. They don't know exactly the breakdown, but they're telling us, hey, there's so much of a breakdown right now, and then there's so much of a breakdown over the next number of years, and they're giving that. So I'm using that breakdown and scrolling down in my model, down, there's one black line, there's another bunch of other metrics, and then there's this whole section here around line 133 downwards where it says sum of the parts, and that just means the sum of the number of policies, and then we have each product line, so renters, home, pet, car, and Europe. And so what I've done is projected out into the future, and I have them encircled in red boxes here, a date where I'm roughly going to be hitting these sort of rough targets for this approximate breakdown. I measured these pixels here, measured with a ruler, digital ruler, and found the sort of rough breakdown of the product mix, where you have 4 billion plus of car, and maybe Europe's 950 million in premiums in Europe, et cetera, just based on that graph. So, and then I've plugged in the backwards across the model, going back in time for each product mix back today, and based on all kind of, instead of going based on customer count, I'm going based purely on premiums, and then figuring out premiums per customer, customers, other sort of metrics to look at around that, but mainly going backwards in time. It's kind of a weird equation I have in here, because I'm adjusting it so that, hey, if I change, next quarter, and maybe renters, if they give us a breakdown of renters and say this is not going to happen, but say renters was suddenly 500 million of the book, it would automatically adjust all of the other quarters going forward. So you still land at that same amount of, say, 1.1 billion in renters insurance. So, but if it's not there, it's still going to be the 1.1 billion. So that's just the way I programmed it. Oops. Jump ahead back to where we were there. That's the way I've programmed or done the sort of calculation for each of these, so it's easier to adjust into the future. So anyways, the important thing is you have this breakdown for all your whole product line, and then I've taken that back to the top of the model and input that into my IFP line. So IFP is just sort of roughly growing at, I have it as, that they're going to roughly 10x the book of business, go from maybe 960 million of premium, in Q4, wherever Q4 comes in at, out to 2032, roughly, I have about 9.7 billion. So roughly 10x over an 8-year span. And if you go 10x return over an 8-year span, you're talking about a 33% average compound annual growth rate. Now, Lemonade said 30% at Investor Day, so why am I doing 33? Just because management tends to, if anything, be a little bit conservative. So I thought, hey, maybe they're going to actually beat that guidance over this whole span of time. So that's the roughly how I get the top line IFP. I sort of assumed from this sort of Investor Day prediction. And then I'm working backwards to say, okay, how much are we going to spend on growth spend to get us to that amount of growth? So within that, of course, you have annual dollar retention, a certain amount of your premiums that's churning away. But also within that is I'm breaking it down. I'm showing here below this growth section in lines 36 to 43, where you should have annual dollar retention, churn, customer acquisition cost, et cetera, et cetera. I'm also showing a customer acquisition spend. If you spend $1 in growth spend, how much premium are you getting? And then I am also showing, if you exclude the amount that's being cross-sold of the premium you're getting, because a certain amount is just being cross-sold within the book of business, then what does that work out to? So I have some historical numbers for that. Again, I kind of talked about this in the previous video, but I'll just review it here again. You can see where that numbers come in at, 2.23, last few quarters lower, 1.39, 1.89. And it's lower down. I have a lower down here in my model. In the next section, I have percentage of IFP acquired that upsells or cross-sells, line 107. And this is based on different comments through different shareholder letters and say questions, and where Daniel's answered some of these, and where I've talked about basically we're at about 30% right now. It was lower. 21%, of course, is lower as you have less products, less places, and you have more products, more places, more offerings, and more customers. This number is going to go up. And I expect it to. There was some data that back in, Illinois in 2022, when car was ramping there, it was as high as 36%. And so I'm averaging that to 30% now, and assuming car rolls out more, we go to 32. Actually, this should be 34, just a typo there. And 34% is kind of where I'm averaging that out at in the long term. So you're really assuming they keep continuing to grow in their markets that they're available and all the product offerings that they're available, so that they have a healthy, good, solid amount of cross-sell that's going forward. Of course, maybe this is lower, maybe it's 30%, but I think it's still going to be somewhere in the 30 plus range, just because you're always going to be, there's always going to be more young people coming that you're going to attract. You're going to bring into these pet funnels, renters funnels, and then those people you're going to cross-sell over time, and you're just going to expand. They're going to be more of a presence in Europe. Hopefully someday they'll be in places like Canada, they'll be in Australia, maybe other countries around the world, and they'll have more opportunity, sort of more market that they can continue to mine into and get those younger customers early. There's always going to be a younger person coming. Every year there's another, 18-year-old or a group of them. And these people, you're going to constantly be acquiring a segment of them and then upselling them. So it makes sense to me this could stay as a pretty strong number for a pretty long time. But at least that's how I have it numbered or input right now. And then this IFP that's outside of what's being cross-sold. I mean, it's tough to say where this is going to come in at, but I'm saying 1.8 this year, and as you have more opportunities to directly market car and other products to more people immediately directly, then this should go up. So I have it going to 1.9. It's a function of how much you're spending on marketing and how much sort of the lowest, easiest ripe fruit you have to pick. So if you're maxed out in the markets you're in and you keep spending more and more and more dollars, this is just going to diminish and go down, 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 down. If you spend an infinite amount of dollars on cross sell, this is going to trend to zero because most of those infinite dollars you spend do nothing, right? So it's a function of you're adding more and more growth spend, and within the markets you're in, it's going to diminish and push this down. But then I'm also assuming that they're constantly going to grow the markets they're in and the availability they're in and the product offerings they have in those markets to attract new customers. And that's going to sort of march across the earth as they're still, even at the end of this modeling, they're still a relatively small insurer. It's pushing, I'm assuming you can maintain that. That's a big assumption. We'll know more, I think, big time Q4 as we know they're rolling out. They've been spending more on car and Q1 and on and on. Will tell us a lot more detail about the future with that metric. But I'm just putting in 1.9 consistently now into the future, even though the last few years has been an average of 2.38. So I'm lower than where we've been, but I'm also assuming, hey, you're going to keep spending more on marketing, so that's going to diminish. But again, you have that opportunity as you roll out you create more opportunities for yourself. Then you have more low-hanging fruit to pick. So that's kind of the balancing act of this marketing and where I see that going. And roughly, I mentioned here as well from the top line, 2032, I have near the end of that is just under that $10 billion mark. You're kind of hitting right around the end of 2032, 8 years from now. And then I have continued growth in the 30+% for a few more years up to, we're at end of 2035, 23 billion in premiums. I don't know if this is totally realistic, but we'll see. And based on the sort of rough customer mix, product mix, premium per customer mix, you're at like 22 million customers and $1,000 in premium per customer. Still relatively low premium per customer because you have so many customers still. Renters, pet insurance, that kind of thing. Other things I want to talk about with this model, and then the valuation we're going to get to here right away. But the non-growth spend, so whatever is not this line 43, but all your other operating expenses, I have growing at about 1% a quarter. So the other, sales and marketing fixed, they have a marketing team, they're growing. I have that growing at 1% a quarter. So compounding 1% a quarter because they roughly said maybe 5% OPEX growth at an Investor Day, but we also heard even more bullish things from Daniel, from Shai about this sort of autonomous organization they're building. So I have 1% growth for most of my operating expenses going out into the future quarter over quarter. A couple of the more recent years I have a little bit even less tech growth as it's a little expected to be. They've probably pre-advanced some of that expenditure, but roughly kind of that 1% quarter over quarter growth for all those operating expenses. And then investment income I have assumed to be at 3.75% of your cash and cash equivalents pile. So on an annual basis, so 3.75%. Is what I have for their income tax. I'm using a 21% tax rate on income tax. And then share dilution, so number of shares outstanding. You can see it's been growing. We're at 71 million now. We're at 69.8 million a year ago. I have that growing at about 0.3 or 300,000 shares per quarter. And then I have that slowly accelerating at another like 1% quarter over quarter rate on top of that 300. So, if you're projecting out to 2035, you're at 87 million shares. Maybe that's too low. My thinking is a couple things. I don't know. I don't necessarily think they need to do a capital raise. So maybe they'll do a capital raise and this accelerate growth even faster. But I don't know if I see that happening. If they reach profitability and they have the unit economics to scale at a pace that they want to scale, it's like why they may not necessarily bother with that. So I'm not factoring that in. And then also I'm assuming if they have if they're this really autonomous organization that's really, really efficient, they have less people they need to give shares to and less people they have to sort of give incentive to and pay via shares. So you could have a sort of a lower amount of dilution overall. So still is dilution built in there, growing from 70 million now in 11 years from now to 87 million, right? So something like that. So still a decent amount of dilution over that time. So then I have from your net income, I have an earnings per share line. Then I further down here, we have sort of miscellaneous metrics. I put that on a trailing 12-month basis, line 117. And then we have that graphed out here where, again, we're breaking even here, and then all the way out to 2030, we're maybe possibly above in the $20-something per share of earnings per year. So would be pretty tremendous if they're able to do that. And then basically down here, the way I presented this is line 86 to 89. I say here's a share price at a given PE of whatever you input here. So, and this is just roughly applied, across all the quarters. Of course, as soon as they're profitable in 2027 or 2028, they probably don't deserve the same PE ratio that they're going to deserve in 2035. But you can adjust this number and then look at the quarter you want to see. I thought that was the easiest way to do it. So if you say, they deserve, if they're going to get a PE of 100 really early, you might say, oh, they might be worth, in 2029 or 2030, might be worth somewhere between $1 to $200 and some dollars per share. Now that's just a rough share price based on the trailing 12-month earnings per share multiplied by the PE that you want to give them. Now, if you look, as you can see in the model, as they keep scaling growth, operating expenses are really flat, your profitability really sort of soars and takes off, right? So it's, of course, the further out you look, and if you're accurate in those predictions and you're discounting that back to today, then you can make the argument that the stock is worth more today. So I put in a red box here the present, all of these values below in these three rows reflect this from any quarter onwards. But thinking about today where we're at Q4, I'm saying, hey, the present value right now, or in Q4 of where we're at right now, at a discount rate of 10% from 2035, from 2032, and 2029. So roughly 5 years out, 8 years out, and 11 years out, and a 10% rate. Now, this is giving a 100 PE ratio to 2035's values. It's going to be way too high, but say it's a 30. If it's a 30 PE ratio and we scale out to the end of 2035, and maybe we're worth $600 per share then at that time. Oops. And that's fine where we're at here, but we're worth and we discount that at 10% per year back to today. It's saying, hey, Given all that, we're worth $224 a share. If they can execute all the way to 2035, of course, there's the further out you look, you have to give a bit of a further discount to say, just for execution risks, just for uncertainty as you project further into the future. Of course, it's going to be less and less certain. But 2032, you might say, yeah, right now we're worth, based on 2032's projection, which is more like what the numbers are giving us Investor Day, you're saying it's worth $200 a share then, and discounting it back at a 10% rate, maybe we're worth $90 a share right now. Now, again, this is still at a PE of 30 at 2032, which you might say, well, actually, it shouldn't be 30. At 2032, it should be 40. So then maybe it's worth $124 a share. Or maybe it should be 50. And then you say, well, actually, it should be worth $155 a share right now, depending what you think that PE ratio should apply to the year you're talking about, right? So again, if you look at 2029 at a PE of 10% discount rate and a PE of 30, so only 4 years out, you can easily say, yeah, it's worth at least what it is worth by the market right now, and you're still going to get 10% a year if they can execute towards that, and they only get a PE of 30 at the time. Of course, if it's less, you're in trouble, and the stock really should be worth less than it is right now. But I don't see how. I think there's less, it's much less and probably a less execution risk when you're only looking at 2029. And then to say a PE of 30 when you still have all this potential growth and profitability growth as you really have, maybe you're growing the top line still 30% for a long span of time, and your operating expenses are 5% growth or less. Well, your profit's going to be growing still, close to that 30% range going forward. So it's still in my mind that 30 would easily, maybe that's like a 50 PE ratio, and it really should be at a minimum, based on as far out as you can see there, should be worth $50 a share. But maybe you're saying, it should be worth like 60, and it should be maybe worth $60 a share, just based on that sort of smaller view, only looking to 2029. But we know if their operating expenses, they get the operating leverage we expect them to, then you can look out further, and you can make the argument that they're worth more today. They're worth $93 today, or they're worth $120 today, or something like that. And if you you increase the discount rate, say, of course, now they're not worth as much now in that example. But if you lower it, say you only should be 8%, and you say this should be 35, then you can make the argument this 2032 case should be worth something like $120 per share. So it gives you a bit of an idea. Maybe we keep them all at 10%. And maybe in the 2035 case, we say, you're not going to get a PE of 30 anymore, but maybe you get a PE of 20. So we say maybe it's worth, at the high end, $149. And maybe at this case, you say, we should get like a PE of 80. And you say, at the low end, you're $84. So maybe it's $84 to $149. Maybe that's sort of the good, fair value today. And this middle ground kind of meets in the middle, where you say, maybe it's a 35, and you say it's $109. Maybe that's what it should be worth right now. So hopefully that gives you some insight into how this is structured, so you can play with it yourself. You can also think about it, some of the variables we picked. I feel like these were pretty good. This percentage of IFP is cross-sold, upsold. I think that's pretty good. I think the operating expense growth, 1% quarter over quarter, I think that's pretty good. This one I'm less certain on. Maybe, like right now where I'm at this year, I don't have it quite as high, and I'm expecting them to expand more and keep pushing out products more places. So I have at 1.9 across the board. So with that, my max end bar here is $21 of earnings per share in 2035. But say I made this, say this was bumped up to 2, and the whole way across, the average growth conversion rate was 2 instead, well, now you're up to, it adds about $1 of earnings per share in 2035, just because you're saving that amount of money on your growth spend over the years. So you then, at this case, this middle case, you might say, oh, now they're worth $120 a share instead of $109 a share like we were before. So I'll just revert that back, though, to the 1.9 where we were at. If you say you're only worth 1.7, you're going to say they do 1.7 as the overall average. And I'll just punch that in, 1.7. Now you're dropping down to like $17 in earning per share at that, that end sort of state case. And you can make the argument still maybe that they're worth, $80 a share is a good fair value at a 10% discount rate. Pick the discount rate you want, play with it as you want. But again, I will just bump that back to the 1.9, which I kind of feel like is a good estimate for where we're at right now. And then the other way you can play with it, like maybe let's go the just for fun. I mean, I don't expect this, but let's say they're super bullish case. So we go 2.25 there. So we'll just, I'll just paste that all the way through. 2.25 there. That bumps your earnings per share up to $26 at the end. And then let's move let's say they actually hit 30. From here onwards, I'm going to say they hit 36%, have cross-sell, upsell, and I'm going to just paste that in all the way across the board. And that's going to drive us all the way up to $26, almost $27 of earning per share. And we go back to where our valuation is shown here. You can make the argument that they're worth more like $149 per share right now based on those inputs. I think that's, those are probably a little too bullish, but it's interesting to kind of look at those different scenarios. So I'll just undo those ones, undo this growth spend conversion from IFP. I really hope this was helpful in illustrating, how this is working, how this is modeling what your earnings per share would be, and how this can tell you what your present value is based on that. And thank you so much for being here. I'll see you in the next video. Thanks for watching. Remember, it's in the bag.